Welcome to this lecture on segregation of duties and authorization controls. In this session, we'll explore how these two critical internal control concepts protect organizations from errors, fraud, and inefficiency by ensuring accountability and proper oversight. Segregation of duties, often abbreviated as SOD, is a cornerstone of effective internal control. It's based on a simple but powerful principle. No single person should have control over all aspects of a financial or operational transaction. By dividing responsibilities, organizations reduce the risk of both accidental mistakes and intentional wrongdoing. To understand how segregation of duties works, think of a transaction as a three-step process: authorization, execution, and recording. Ideally, different individuals should perform each step. For example, one employee initiates a purchase, another approves it, and a third records it in the accounting system. This separation ensures that no one person can manipulate the process for personal gain. Let's look at the four key functions that should be separated in any strong control system. First, authorization, approving transactions and ensuring they align with policies and budgets. Second, custody, handling or managing assets such as cash, inventory, or equipment. Third, record keeping, maintaining documentation and entering data into the accounting system. Fourth, reconciliation, reviewing records and verifying that transactions were properly processed. If one person performs multiple functions, the opportunity for errors or fraud increases dramatically. For example, if someone who approves vendor payments also records them in the accounting system, they could create fictitious vendors and authorize fraudulent payments without detection. Authorization controls work hand in hand with segregation of duties. Authorization ensures that every transaction is reviewed and approved by the appropriate level of management before it occurs. This control prevents unauthorized spending and enforces compliance with organizational policies. Authorization levels should be clearly defined. For instance, department managers might approve purchases up to a certain limit, while higher value transactions require executive approval. Automated systems can enforce these thresholds, preventing employees from bypassing approval requirements. Documentation is another key aspect of authorization controls. Every approval should leave a trace, whether through electronic workflows, signatures, or digital logs. These records create accountability and provide audit evidence that controls are functioning effectively. Technology plays an important role in implementing both SOD and authorization controls. Enterprise resource planning, ERP systems, for example, can automatically restrict user permissions, ensuring that employees can only perform tasks relevant to their roles. Access management features help enforce segregation by separating duties between users and requiring dual approvals for sensitive transactions. However, even with technology, segregation of duties can be challenging in smaller organizations. When staffing is limited, one person may have to perform multiple roles. In such cases, compensating controls are essential, such as increased supervision, independent reviews, or periodic audits to detect irregularities. Let's look at a practical example. Imagine a small company where the accountant handles both accounts payable and bank reconciliations. This creates a conflict of duties and a risk of undetected fraud. To compensate, the company's owner reviews all bank statements monthly and matches them against supplier payments. This oversight reduces the risk even without full segregation. In larger organizations, automated approval workflows provide an extra layer of protection. For example, when a purchase order exceeds a defined threshold, the system automatically routes it to a senior manager for approval. These digital workflows enhance transparency and reduce the chance of unauthorized transactions slipping through. Periodic reviews of user access rights are also critical. Over time, employees may change roles or responsibilities, creating overlaps that violate segregation principles. Regular access audits ensure that permissions remain appropriate and that sensitive functions are not concentrated in a single individual's hands. Let's consider a real-world case. A major retail company discovered that a manager had created and approved fictitious refund transactions over several months. The fraud was possible because the same person had authority to both issue and approve refunds. After the incident, the company restructured its approval process, ensuring that no individual could approve their own transactions and that all refund reports were independently reviewed. This example highlights why segregation of duties is one of the most effective fraud prevention tools available. To summarize, segregation of duties and authorization controls are essential for maintaining integrity in operations and financial reporting. Segregation divides responsibilities to prevent misuse of power, while authorization ensures that all activities are properly reviewed and approved. Together, they create a system of checks and balances that builds trust, accountability, and compliance. In our next lecture, we'll explore internal control documentation and testing, where we'll learn how organizations record, test, and validate their controls to ensure they're operating effectively. Thank you for joining me in this session on segregation of duties and authorization controls.